When something is recognized, it can be recognized at either cost or fair value. When we're talking about buying property, plant, equipment, let's say building, we just take credit cash, debit property, plant, equipment. So we recognize it at cost. We don't order a market research. We don't try to understand the fair value. But with the financial instruments, it's going to be different. Financial instruments are going to be recognized at fair value. And that is what many students miss. What does it mean? If you have a low interest loan given or taken, then you are going to have either profit or loss on initial recognition. So, for example, if you gave your employee a loan at a very low interest or at no interest at all, the fair value is going to be much smaller than the cash that was given, because the fair value is the present value of all future payments. And as such, your entry is going to be credit cash, debit financial asset at fair value, and then debit loss on initial recognition. And the other way around, if you are the one who got this very cheap loan, then you are going to recognize it at fair value, which is the present value of future payments. It's going to be credit financial liability. You got cash, debit cash, and the difference, credit, since you got it cheap, is going to be profit on initial recognition. And that is what we need to acknowledge when we are given the redemption value and when we are given the interest, and when we have some hints that the transaction is not at fair value. But don't overthink it, because the examiner wants to test only that much. So sometimes we are given information about loans, about bonds, and in there we're not given the payment at maturity date. So we don't need to recalculate the fair value. This is an indicator that the examiner does not want to test this very aspect. They want to test something else. And finally, when we're talking about the fair value recognition, as I told you, credit or debit, that is the balancing figure, is going to be recognized in P&L unless this relates to equity. So, if you have a financial liability, you issued bonds at a value that is not market value, and you promise your shares, so the investors can come at the redemption date and say, no, we don't need redemption, we just want your shares, then in this case, this portion, this difference is going to be recognized in other components of equity. And that is how the recognition can be made tricky in this very exam.